In this video, I'm going to walk you through 4 hypothetical financial scenarios for high-paid executives at 4 different stages of life: 30, 40, 50, and 60 years old. Because the advice you need when you're 30 and just starting to build wealth, it's going to be completely different than what you need at 50 when you're thinking about how do I make work optional. And I see so many people getting this wrong. They're either following advice that's clearly not meant for them, or they don't have any plan at all. I'm going to show you some of the most common scenarios that I see with my clients at each of these stages, and I'm going to give you the top couple things that you should be focused on right now, depending on which decade you're in. This is going to be a valuable one no matter what stage you're at. If you're new here, I'm Mondo Salavanti. I'm a CFP professional that specializes in working with B2B sales leaders to help them plan to build wealth. All right, so let's start with the 30-year-old. This is someone who's probably just starting to hit their stride. Maybe they're making $200,000, $300,000 a year, but they're also dealing with a lot of new expenses. They might have just got married, maybe they bought a house, maybe having their first kid, and they're trying to figure out, how do I balance all of this? So with the 30-year-old, let's take a look here and say that they're making $250,000, but they bought their home. We've got a baby, we've got marriage. So we've got all these milestones that are either past us or we're working toward them. Now, with the 30-year-old, as they start to get into this phase of earning the most money of their life, or at least like entering that phase soon, you don't want to be socking all your money away in a 401k. So if I have a 401k, these can be great vehicles to accumulate wealth. You have different types of 401k. I have pre-tax, where pre-tax dollars go in. I can't really tap into that money besides if I pay penalties or borrow from it while I'm in my working years up until 59 and a half. And then after 59 and a half, I could tap into it, but I got to pay tax. You have a Roth 401k, kind of similar, but opposite. So on the opposite side, after tax dollars go in, it grows tax deferred. And when I go to take it out at 59 and a half or older, I don't pay tax. It's tax free. I could tap into it via loan. I could borrow against it and I could pull money out, but it's taken in a different way than pre-tax. You won't pay penalties on all of it, but you'll pay it proportionately to what you've put in and what your gains are. So hypothetically, like with a Roth, if I put in 50K and my account's worth 100K in a Roth 401k, and now I want to go take out 10,000. They're going to say half of my account is contributions, half of it is gains. So I'm going to have to pay penalties and taxes on half of the $10,000 distribution when I take money out of a Roth 401k. So again, 401k, great vehicle for accumulating wealth. But when you're 30 years old, I don't want it to be where you put all your money. You should have a healthy savings. You should be putting money to what I call non-qualified brokerage. And when I say non-qualified account, what this means is after tax dollars go in, if I have dividends or I have interest on the investments in there, I will pay tax in the current year. If I have a capital gain, either short-term or long-term capital gains, I will pay tax in the current year depending on the tax rates for what type of gain it is. But I like this account a lot, especially for a young couple who wants to build wealth, because it's flexible. There's no contribution limits. I choose how much I want to put in or take out as well. That's the second point. I can take money out of it whenever I want to. I might have to pay tax depending on what I do and if I sell investments, but it's a flexible account. We could take money out, use it for other purposes if life happens, if things change, and you never know what's going to happen in your life. So I would be focusing on, how do I build these buckets up? Additionally, the last thing that I haven't talked about, as a 30-year-old, you really want to be focusing on how you could increase your skills in your career and network, to grow your network, quite frankly, to get opportunities. So grow your skills, invest in yourself, grow your network so that you can get opportunities and maybe find a new job, or maybe you want to start a business. Who knows? Focus on these more than anything. All right, so let's keep rolling. I want to talk about the 40-year-old. And when we talk about the 40-year-olds here, maybe this person is at a point, income's gone up. Maybe it's 400K, let's just say. Kids are a little older. Maybe the kids are now getting up to 8 years old. Maybe we got a 10-year-old. Maybe we had a third kid. We got a 4-year-old running around. And we already have the home. Marriage is behind us. But maybe a goal here is a second home. And maybe college is something we're thinking about for the kids. So when it comes to buying a second home, if this 40-year-old couple had been talking to me when they were the 30-year-old, hypothetically, they would have some money built up in an account they can access, that non-qualified account. We could tap into that money. There might be some taxable ramifications, but we could tap into it. So if that's the case, hopefully we had that built up. And as you look at the second home, you want to consider, how much money should I put down? A big mistake I see when people want to go buy their second home Number one, they buy the home assuming the rental income it will get. So don't just go and buy this and say, oh, the mortgage is $3,000 a month or $4,000 a month or $5,000 a month, and we're going to get $6,000 a month in rents, and we're going to make money and life's going to be good. I'm a real estate investor. I will be the first to tell you, I like real estate, but rents are everything but guaranteed. You very well could have multiple months of a dry spell where you don't have someone renting it. Especially if you're a short-term rental on Airbnb and it's a vacation property, you just never know. So you don't want to buy a second home or a vacation home or a beach home, whatever you want to call it. You don't want to buy that assuming the rents are going to come in. Fit this purchase into your existing cash flow. If you can't pay for it on what your guaranteed income is now, I mean, I guess no income is really guaranteed, but your current income from your wages, if you can't pay for that mortgage, do not buy it. So maybe you got to save up more money and that's your focus. Maybe you got to put more money down. And we have college looming in the background, like I just talked about. So with college, the focus here, how do we pay for school for our kids? Do it in the most effective way possible and save on taxes if we could. 529 plans could be good options for this. You put money in, it grows tax deferred. If you pull it out for qualified education expenses, then the 529 plan is going to be tax-free on the distributions. Could be good, but you could run into a scenario that if you have more money put away, that money then could be subject to penalties partially if it's not used for college in the future. You'll have the option to roll it over to a Roth IRA, but that's subject to limits and it gets to be, you might hit those limits. So if there's more money left over, ultimately, you don't want all your eggs in one basket. That non-qualified account I talked about could be a good idea. There's other things too, but for the purpose of the video, we're going to keep that simple today. All right, quick pause. If you're in your 30s or 40s and you're seeing yourself in these scenarios, here's what I do. I help sales leaders plan to build real wealth that's customized to every stage of their life. If you want to stop guessing and get a clear path forward, there's a link in the description to book a call with me. We'll see if we're a fit, talk about your situation, and we'll go from there. All right, let's get back to the video. So moving on to the 50-year-old. Let's assume with this person, they've accumulated wealth. Income's probably high. They're probably making at least $500,000 a year. Maybe they've got a few $1,000,000 saved up, 2 million, 3 million, whatever it is. And the home might be close to being paid off. Check that box. They probably have college paid for, or it's already funded. Maybe they have grandkids around. We'll abbreviate grandkids to GK. And at this point, they're thinking about like, how do I actually retire? If we look and we draw a mountain here, going up the mountain to retirement, we have our accumulation phase. And then we get there and we come down and it's distribution, which is when we use our money. In my experience, many people have done an awesome job planning for accumulation. They've educated themselves on what to invest in, where to invest, how to do it. They know what stocks are. They know what bonds are. They know what mutual funds, index funds, real estate. They've looked at a lot of options and considered a lot of things. And they get there, top of the mountain, plant their flag, take the selfie. But you know what they never actually did? They never thought about, how do I turn these assets into income? That's what distribution is. Great financial planning is not great if you do not plan for how you actually use the money. There's two parts to this game: accumulating it and spending it. And at the end of the day, we're not doing this so you could accumulate a big account to only be giving a cut to the IRS eventually when you got to pay taxes, and to only be accumulating it to pass down to someone else. Granted, I'm all about building wealth and building generational wealth at that, but there's a way to build generational wealth and spend all the money you want and live the exact life that you've envisioned for yourself, your partner, and your kids all along. So as you're in your 50s and you're approaching this phase, you want to think about, how do the assets actually turn into income? So the default rule is the 4% rule, which if I have 2 million to 3 million, just say, that would in theory tell me I could take out 80 to 120K. The 4% rule, you could reference a study from the 90s where there was studies done and numbers ran that basically show if I take 4% of my money per year, I should be okay and not run too close to running the risk of running out of money. Not perfect, not necessarily what we do with clients. We have a bucketed approach that we use, and that's in another video that you could check out on my channel. But let's just say that's 80 to 120K. That's not a lot of money for having 2 to 3 million bucks. So we want to create money for different purposes, and I'll give you the abbreviated version of the 5-bucket strategy. But I would look at, how much guaranteed income do I need? GI, guaranteed income. How much money do I need for my short-term expenses? How much money do I need for leisure every year? I want to travel. I want to do things. How much do I need for that? Additionally, what about if we get a downturn in the market? How much money do I need for that? What if I get sick? How much money do I need for healthcare? So these are the 5 buckets that I want to plan for as we look at retirement for someone who's in their 50s and looking ahead. We need to make sure we have money allocated for different purposes for different people. That's all I want you to consider. And moving on to the good old 60-year-old. You've hit the mountaintop. So we'll draw my little mountain again, and it'll be a little bigger. You've got there. You've accumulated the money. Accumulation is checked off. Now you're starting distribution and you're retiring before 65 because you worked with a financial advisor who did a great job. Hopefully you're one of my clients watching this video and this is what we're doing right now. But for this hypothetical scenario, let's say, I don't even need to put numbers to this because here's really what I want this person to start considering. Let's make a couple assumptions though. RI for retirement income. Let's say the box is checked there. We solved that problem because when we looked at the 30, 40, 50-year-old, we did all these things. We saved money. We invested it wisely. We were strategic with our money. We're proactive. We considered all the risks, the pros and cons of our decisions. We hit the mountaintop and retirement income's taken care of. The thing that you need to be worrying about when you're 60 is what happens to the next generation. Think about how often we hear of families who are wealthy and have accumulated money, but you hear like the average wealth is dwindled down or spent down after 3 generations. Most families, it doesn't even last. So critics of generational family planning will say, oh, the next generation is just going to spend it down anyways. Well, if you're 60, your biggest focus really should be, if you've done things right, and now you're looking ahead and you're not just caring about yourself, you're caring about everybody after you. Should be 2 big words: estate planning. Now, notice that estate planning is a verb. It's not a noun. You don't just make an estate plan and stop there. You get a really good attorney on your team. Your financial advisor speaks the same language with your attorney, and they're on the same page. With your estate planning process, you want to look at where are my assets positioned and how are they going to be taxed when they go to the next generation. Better yet, who owns my assets? Do I own them? Do I have a trust own them? Do I want to start gifting to my kids? Do I want to start gifting to my grandkids? How can I take advantage of these things? A strategy for this is best executed by having a great financial advisor, a great estate planning attorney, and in many cases, even a great tax accountant involved. So look ahead. Don't just plan for you, plan for the generations after you, because the best financial strategies account not just for today or next year, they account for the next generation.